All right. Well, thank you everyone for being here. This is going to be a lot of fun. This is an awesome event, TrendSpider. I'm so honored that you invited me. Right. I talk about a lot of stuff. We'll see how this goes the next 35, 40 minutes. Hopefully the listeners and viewers get something out of it. But I'll say this much, the guests we have, the TrendSpider has so far have been awesome. I know some more are coming. I can't wait to watch some of the replays of all the different guests. I know this has been a great event, and it's really important, right? Because you think about what's going on. We're in a bull market, the economy is doing well, but oh my goodness, here's this recession coming. Recession, wrong word. Election. I don't know if that was a Freudian slip. There's no recession coming. I'll talk about that. There's an election coming. What does it mean? And I've got as usual, probably people follow me on social media. I've got a lot of charts and a lot of things we're going to dive into here. So we're just going to get into it. Kind of called this one Managing Your Wealth Insanity in an Election Year, because I think that's a big part of it. I'm Ryan Detrick, Chief Market Strategist with Carson Group. What in the world's Carson Group? We are an RIA with approximately $38 billion, almost 500 financial advisors in 42 different states all around the United States. And I've been with the team over 2 years now. My job's a lot of fun as a market strategist. I get to talk about stuff like this, right? I get to travel the country, talk to work with our financial advisors, talk to their clients. I work on a 16-person research team that manages billions of dollars. One of the cool things that I'm going to talk about today, and anytime you see me out in the media, what I'm talking about, it impacts, right, how our team is, what our team is up to, what we're seeing. It's not like all my opinions go into everything. We have a team approach, I want to be clear, but when I'm speaking, it's what our team sees. It's how we are investing real money for clients out there every single day. And it's something I like to, we have a lot of fun with, but something we do not take lightly. So let's just get into it. Keep your eyes on the prize. This is an oldie but a goodie. I'm sure a few people have probably seen this circling around the internet. You always have a plan, right? You got this plan, like, here's my long-term investment goals. Oh, great. I'm going to wait a couple decades. It'll be nice and easy. That's the top, right? Well, the bottom's reality, where we've just had. I mean, just in the last 4.5, 5 years, we've had two different bear markets, right? If you're a long-term investor, really, you shouldn't be too worried about bear markets. Honest to goodness, they're part of the process. They've happened before. They're going to happen again. But the reality is, someone who gets to work every single day with financial advisors and specifically their clients, we know emotions matter. I'm wearing my shirt here. Facts versus feelings. It's my podcast. It's important to look at the facts, but feelings clearly matter as well. We'd rather focus with facts, but we are aware that feelings matter also. And I make the joke, this summer when the Salesforce thing all went down, I was traveling Delta. I was supposed to go to Minnesota, Minneapolis, which is a Delta hub. I thought it'd be like on the top, but getting to Minnesota was anything but. I got home like at 2 a.m. because my flight didn't leave on Delta. And then I took a 6 a.m. Frontier flight. Now, listen, think what you want about Frontier. I got like 90 minutes of sleep, took an Uber back to the airport, made it. But my trip to Minnesota this weekend was the reality, and it was anything but smooth. And that is investing in general. Now, listen. There's lots of news, and I know I'm here to talk about the election, but I'm doing a big picture view here for a little bit, and then we're definitely going to dive into the election, how we see, the kind of things shaking out. But again, just look at the news lately, right? We just had some just terrible news lately. Yet stocks are literally, at least as of the end of September, having their best start to an election year ever in history, up well over 20%, right? The first 9 months of the year. We'll see what happens in October, and obviously election coming up. We'll talk about that stuff. But there's lots of bad things. You've all seen charts like this. This is what we made. Just a lot of negative things have happened since May 26th, 1896, when the Dow started trading. The good news, there's been a lot of good things that have also happened. They say the stock market's the only place that things go on sale, yet everyone runs out of the store screaming. Right. And you think about you want to buy some shoes. If they're on sale, well, maybe you buy your shoes. Maybe you got that favorite equity, favorite stock out there. I can't really talk too much individual equities, but there's some stock you like out there. It's down 15, 20%. You probably loved it when it was up 15, 20, then it's down. And you kind of have to rewire your brains. It's not our fault. It's how our brains are wired from caveman days. When something bad happens, we follow the crowd and we run the other way. When it comes to investing, listen, I'm not saying always be a contrarian just to be a contrarian, but we do have to rewire our brains to a degree, and kind of remember that throughout history, bad things have happened, bear markets have happened, but to use those likely as opportunities to reach our long-term investment goals. And that's why you get to this election we're going to talk about. Lots of fear, lots of this, lots of that. What could it mean? The last couple elections, we saw sell-offs ahead of the election, but then rallies after. We'll get into it, but those are really important things. Now, Will Rogers said, "I don't make jokes. I watch the government and report the facts." I like that. I've got some other funny election government quotes coming up here. So what could happen? Listen, I could talk an hour on this. I don't want to. I don't need to. You can take a picture with your phone right now. I'm sure we're going to share that. We can share this deck later with people if you need to. It was something our team created at the start of the year. Carson Investment Research Team put this together kind of if President Biden were to win. And I get it. President Biden didn't win. That's why we did a fun little scratch his name out and put Harris in there. If President Trump wins and you break things down. I mean, the reality is, yes, the Trump tax cuts, kind of hard to say. The Trump tax cuts are right there. Who wins, of course, matters, but the breakdown in Congress is going to matter as well. Obviously, corporate taxes. I mean, if President Trump wins, hey, maybe you get a cut in taxes or you keep it there. Obviously, if Vice President Harris wins, that's going to swing things a little bit away. She's already said she wants to increase taxes, right? That shouldn't be anything new, shouldn't be a big surprise. But then how does Congress come out matters. And then tariffs is the one that it feels like, that's there also. Clearly, Trump would probably want to increase tariffs or still be very tough on China, different parts of the world. Now, the thing that's unique about everything the last 4 years, President Biden has not really removed any of the tariffs that President Trump put on China starting way back in 2018. So, we have a divided Washington. One of the places we're kind of unified, apparently, is being tough on China. So those are some things we're watching there. Now, what's not going to change, I'll get more into this at the end, defense spending, discretionary spending, having deficits. It's just kind of how big these things are going to be. I don't think it matters who wins, which side, and even how Congress is made up. Those are the kind of things we know on the other side that are probably going to stay the same. It just depends on how big these changes are. Now, this is a really cool chart from PIMCO. Big fan of PIMCO. They do awesome work. Again, you can kind of look at this is again PIMCO's opinion, but I kind of follow what they're up to over there. Libby Cantrell put this together, and we've done a lot with Libby over the years. So when she speaks, I like to listen. Again, these are some breakdowns and things. You can take a look at this, later, and dive into potential breakdowns. But again, it's all about taxes. It's all about the deficits. The tariffs. Those are the things that matter. And to be very blunt, to be very honest, we aren't going to know how it all shakes out until well after the election. And now here's where I want to go with this. It isn't easy. Don't you love AI? I said, give me a picture of the last three presidents all sitting back, drinking a beer, having fun together. I don't know if that is reality. In fact, it's probably not. That all probably be hitting each other right there or something, but they're having fun right now. So it is possible. But you think about it, a lot of people didn't like President Obama. Stocks did amazing. A lot of people didn't like President Trump. Stocks did amazing. A lot of people didn't like President Biden. First 2 years, yeah, not too great. Boy, oh boy, the last 2 years done really, really well. And let's not forget, when President Trump won, the talk, energy is going to do great. Green energy is going to do horribly. Oh, he hates Jeff Bezos. Tech's going to do terrible. Like all the opposite stuff happened. Coal. Oh, he's going to be great for coal. Coal did very poorly because it's all about kind of regulations and supply and demand. And if you regulate things, well, sometimes, if demand is still there, or supply is kind of going down, what's going to happen to the price, right? So it's not as simple as you think. And then with President Biden, when he won, well, green energy is going to do great. Dirty old coal is going to do terribly. Dirty old crude is going to do horribly. What's the strongest group? Like energy. Energy's been the strongest one, right? And coal, literally, they took KOL. Remember that ETF? They killed that ETF because there's no need to have coals. All the coal companies out of business. Well, the few coal companies that are around, been like the strongest possible thing you could have bought under President Biden. So I'm not minimizing kind of, how things will shake out after the fact, because policy clearly matters. But I will say we'd be somewhat skeptical if someone tells you, well, if so-and-so wins, this has to happen, because it usually isn't so clean and so clear cut, is what I want to say. Mark Twain told us if voting made any difference, they wouldn't let us do it. That's another good one there. So big picture stuff. People like me for some of these things, so we'll get into this in a minute and then talk election along the way. The bull market turns 2 On the 12th, October 12th, the bull market turned to, right? October 12th, 22, the end of a 25% bear market, vicious bear market. If you followed me at all, Carson Group, we were on record around the second week of November 22 saying that was it. The lows were in. To say that that was hated, to say that that triggered people would be an understatement. The majority of 2023, we were bullish, saying there's no recession, saying stocks are going to do really well. It wasn't a very popular call. But here's another one that's not very popular, but I'm just going to do it anyway. This bull market's 2 years old now, gained about 60% the first 2 years. Your average bull market, okay, and by the way, remember there's this joke about a statistician put his head in a bucket of ice, feet in the oven. They said, "How do you feel?" He goes, "Well, on average, I feel pretty good." They get worse. Sorry. But nonetheless, I don't know where I was going with this. Oh, averages. So the average bull market, as you can see here, is last like 5 years. This one's only two. All right. Average bull market gains 180%. Now, listen, that is skewed by, you can see there, what was it? The almost 600% rally from 87 to 2000. But the median still over 100%. So yes, this has been an incredible move the last 2 years because stocks have gained like 20% 2 years. But don't forget, the S&P went like 2 years without a single new high, 2 full years of going nowhere. So now we've got this 2 years of good moves. So it's all about, listen, we had a lot of pain. 22 was not very fun. 22 was like one of the worst years for stocks we've seen in a long time, but it was like the worst year in the history of bonds. Okay. Ned Davis research says the worst year for bonds since George Washington was president. I don't know how they came up with that number, but if you have a diversified portfolio in 22, stocks did terribly. Bonds did not give you the zig when stocks usually zag. The last 5 times stocks lost 20% for the year, bonds are up double digits every time. That was not the case in 22. So anyway, and then just interesting stuff. But what's the word I'm looking for? Bull markets tend to start in October. Midterm years of a bull market, midterm years of election years, midterm years 22, tend to bottom in October. These are things we talked about repeatedly. People didn't believe it was possible, I guess, because of the yield curve, apparently. But there's a lot of other data you can look at, and we've been sharing it. The reality, though, this bull market is young, so happy birthday to the bull and keep going. Some quick ones. We'll just hit on these. What did we know coming into this year? So again, I'm a market strategist. I look at everything through the lens of what's the market doing. I have a CMT, right? I'm a disciple of John Murphy, stockcharts.com. The message of the market, and some other great speakers you've had on, they're going to be on today and different times. They maybe really dig into the weeds of policy and things like that. I'm all about like, what's the market telling us? Okay, we can talk about the election, talk about the economy, talk about the F word. I hope I'm allowed to use the F word. I think it's not going to offend too many people. The Fed, that's another word that triggers people anymore. But the reality again is, what did we know? Which one do I have here? Okay, good. The last 10 times did a president up for re-election, and I get it. This has a big asterisk on it now because President Biden did not choose to run again. But the reality is, coming into this year, when you have a president up for re-election, the S&P has been higher the last 10 times, up, what is it, 12.2%? Yeah, up 12.2% on average. It's just one stat, one data point, one thing. Don't always, people, I share stuff on Twitter and X, and people get fired up. It's like, this is just one tweet. All right, I don't invest anything. Our team doesn't invest anything in just one data point. We look at hundreds, thousands of data points and combine them all to come up with our overall macro and investment thesis. But knowing this coming into this year, hey, things usually pretty good when you have a president up for re-election. What do we also know? When you have a red midterm year, you almost should root for a red midterm year, apparently. I mean, so let's see my math right. 25, so that'd be 26. 26, honestly, maybe stocks go down again. We've been bullish. We think stocks will do pretty well next year, too. We're putting the finishing touches. We're not finishing touches. We're kind of starting working on our outlook. We think stocks are going to do pretty good again next year. But once you get to the midterm year, things maybe can be a little upset. And when you have a red midterm year, as you see here, the next year, the pre-election year's never been lower, but the election year's never been lower. And again, these are things we knew coming into this year. The things we talked about all the time to put the groundwork in. Yeah, elections are scary and they're uncertainty, and a lot of people are going to get mad, a lot of people are going to get upset. But from an investments point of view, as a market strategist, these are things we need to focus on, that things tend to do pretty well. Also, when you gain 20% in a midterm, in a pre-election year, like we did last year, the election year, never been lower. Yeah, it's not like, do we have any 20% gains there? Yeah, there's one. I guess there's one in the mid 90s. But the reality is, again, it's unlikely to have back-to-back 20% gains. We've been on record all year saying, listen, it could happen this time. And, I'm going to talk about the economy briefly, but the reality is that we continue. We've had 3% GDP last quarter, maybe 3% this quarter. We've had strong productivity in our country, like the strongest productivity we've seen in our country since the mid to late 90s. Periods of extended productivity, like we're seeing now, first time in 30 30 years. You know what happens? The economy tends to surprise to the upside. Sono Varghese, I do this Facts versus Feelings podcast with him. Great guy. He's been on this view that we're going to have a lot better productivity. He's been talking about this for like 18 months now. We've been having strong productivity for like 3 or 4 quarters in a row, maybe even 5 quarters. We've been having it for an extended period of time. When you have better productivity, the economy does better than people expect. That's just how it is. With strong productivity, that's this thing that's going to continue to push the economy higher. We don't see a recession. You put all that together with the fact that it's election year, with the president up for re-election, with a 20% gain last year, with a negative midterm year, to be up a lot right now should not be a surprise at all, honestly. If you look at these things, pre-election years, it is what it is. Normally are pretty strong. And then check out election years, higher 5 out of 6 times, give or take, approximately 83% time, so right around there. But we had huge drops in 2000, huge drops in 2008. It is what it is. Also, Republican presidents, by the way, totally random. But the tech bubble burst, and obviously GFC. That's why that average return isn't that good. But all in all, election years usually are pretty good, which surprises people. We'll get into kind of when most of the gains happen here very soon. But just some things to think about, or to have already thought about, to be honest. Churchill said the best argument against democracy is a 5-minute conversation with the average voter. I think that's 5 minutes might be a little long, but anyway. When do those gains tend to happen? It's later in the year, right? October in an election year is actually negative. It's the worst month out of the 12 in an election year. So just something to think about here in October. We'll see if we get some of that volatility, October surprise, October jitters. But November and December historically are really strong. Now, listen, this election year's the way the markets behave been unlike anything we've ever seen. Like I mentioned, it's like the strongest election year we've ever seen. Normally, the first half of the year isn't all that great. So listen, it's a guide, right? Looking at seasonality and some of these look, history doesn't repeat itself. It often rhymes. Mark Twain, I like to use that. These are guides that we're looking for. I mean, Jeffrey saw it. I'm probably someone said it before Jeff, but Jeff says, listen, in bull markets, surprises happen to the upside. Okay. We are in a bull market. We've been in a bull market for a while. We've got an economy that continues to surprise, a consumer that's still pretty healthy, corporate profits at all-time highs. Our valuations stretched a little bit. Yeah, they are stretched a little bit. Doesn't mean they can't continue with profits continue to improve to the upside. So you stack all this on top of each other. And yeah, I mean, we've had surprise the upside, but election years tend to have a late year rally. I don't think this year's going to be different. I wouldn't be shocked at all. We had some pre-election jitters here as we get closer to the election, maybe even after the election a little bit as we kind of side through what it all means. But then we'll get likely that upward bias into the end of the year. And here's just another way of showing this year. Again, this year's up like over 20% or so, at least as of the end of September into early October. And here we are again. This is a really, really good year versus what your average election year looks like. Fourth quarter's best quarter of the year. Again, kind of talked about this already, but just overall, higher close to 80% of the time. It's higher a little bit more when you're in election. I'm sorry, in an election year. Sorry. So I'm looking at all fourth quarters up over 80% of the time. Up what is that? 4.3% average. And just something to think about. Again, it actually is a little bit better in election years like we are. But something also when you are up 8 of the first 9 months, it's bottom right there. What happens in the fourth quarter? Things get better. Market's been never lower in the fourth quarter, and even better return. So a good, strong start to a year, like we've seen historically, strong start. You actually might get more upside. Now, is that because it's a lot of institutional investors are chasing because they're behind? That's the most logical argument. I think that really could be true. I mean, we do this. I mean, we talk to people all the time. So many people have missed a big chunk of this bull market, and once you get through that election, I think we could again see another chase. Um, Churchill again, Americans will always do the right thing after they've tried everything else. That's another interesting one. So we'll talk about this, just make it quick. On the left, forward S&P 500 earnings at an all-time high. All right. I mean, it's up over like 267, 268. Yeah, that's forward earnings. It could change. Here's my argument there. It could also change to be a little bit stronger. That's what we've been seeing for like a year and a half now. All right. Forward earnings to start of 23 were like 225. Now we're pushing almost 270. That's why stocks are at all-time highs right now. Nothing to do with the Fed, nothing to do with the election, nothing to do with Congress. It's because corporate America continues to be agile, continues to improve. I don't have the chart, but profit margins are actually going higher also, along with profits. That's a dual tailwind. Now, I can spend all day on this. I'm not going to. On the right, we hear it's a bubble, it's a bubble, it's a bubble. Yeah, some years you tend to see, let me make sure I'm reading this right. Yeah, some years you see multiple growth, right? Some years you see earnings growth. But what Sony put this together on the right, we got like 92% gain the last what do we go to here? Since 2020. Okay, since 2020, S&P's almost doubled, right? But a huge majority of those gains came from earnings and dividends. Yes, a little bit came from multiple expansion. That's okay. You see that in bull markets. But I think it's just really important people to remember earnings are continuing to increase. And that's why, again, what happens with taxes, what happens with corporate taxes, a lot of that stuff is potentially going to matter, right? And we'll talk a little more about it, but those are just big picture things to be aware of. We can skip that one. It's kind of the same thing. We don't see a recession. I'm going to be sounding like a broken record. This is some proprietary data that we have. We have our own leading economic indicators with different inputs. Listen, the LEI, the conference board puts together, has been saying there's a recession for the past 22 months, 23 months, something like that. Ours is not. Okay, ours still does not see a potential recession. We continue to think inflation is last year's problem. We've got a Fed that's now cutting, by the way. When the Fed cuts, there's no recession. What happens? Well, usually stocks have been higher a year later every single time. When the Fed cuts within 2% of an all-time high, like they just did last month, give or take a month ago or so, within 2% all-time high, a year later, S&P's higher. Ready for this? 20 out of 20 times, up almost 14% on average. So you've got inflation coming back. You've got still a pretty solid consumer. You've got corporations growing, hiring slowing down. Yes, but this is that part of the cycle where hiring will slow down a little bit. But again, the majority of the data that we look at, yeah, there's some cracks. You say housing, a little bit of weakness, small business investment. We prefer that to come back a little bit. We think why rate cuts really could help those two areas. But all in all, we simply don't see a recession. This makes people angry also, but households are in some of the best shape they've ever been in. Okay. I know there's record credit card debt and there's record debt. That's denominator blindness. People do not talk about the record equities that we have. I hope a lot of listeners out there have a house or two, own some equities the last 15, 20 years. How you doing? Right. You're probably literally sitting here worth more than you've ever been worth in your entire life, the time we're talking right now. And that is something that's really important. On the left, we're showing incomes and wages are growing faster than inflation. Yeah, inflation was higher than anybody wanted, but something people didn't talk about in 23 and parts of 22, mainly 23. Wage growth and compensation was growing faster than inflation was. Inflation is still high, but it's still growing faster. Now inflation's coming back. Wages are still staying strong. On the right, I've got corporate balance sheets. All right. What's a balance sheet? Well, equities, liabilities. So we took a look at that, and when we had to normalize it though, because these numbers, you have to normalize these numbers. We did it by what? Disposable income. So when we looked at balance sheets and normalized by disposable income, that's on the right. All you need to know, that's the highest it's been in like 25 years. People are in some of the best balance sheet their balance sheets are in some of the best shape it's been in 25 years. Doesn't mean you can't have an economic slowdown. Doesn't mean we can't have a recession someday. But with consumers still that strong, we're optimistic there's no recession coming. We're going to get into election stuff real soon. George Washington was the only president who didn't blame the previous administration. Source unknown. So there's a big question. Who's better for stocks? Republicans or Democrats? Now, before I go there, just know I'm going to give an answer. If you don't like it, just wait a minute, because I'll give another answer you'll like, and vice versa. If you get mad you like the first answer, you're not going to like the second answer. Historically, stocks have done better under Democratic presidents. There have been more Democratic presidents going back in history, and Republicans had the short straw of kind of being in charge in 2000 and 2008 when we had, the tech bubble and the accounting scandals and all that stuff. And in 2008, obviously the GFC. But you can see here again, historically, stocks have done better when a Democrat is in the White House. But we're going to talk about some of the other things here. What we found is when you have a split Congress, which is kind of where we are now and where we think we're going to be when all is said and done. Split Congress stocks have done way better. All right. The last 13, another one we knew coming into this year, last 13 years, split Congress, you know what happened? Stocks went up. All right. So that's something to think about. This year's probably going to be 14 unless we have a really bad fourth quarter versus unified. And why is that? Checks and balances, not too much power one way or the other. That's kind of how this shakes out. And I mentioned, give something for everybody. When the Republicans have both chambers of Congress, Senate and House, stocks do way, way better. All right. So they do way better than the Democrats have both chambers of Congress. So, but kind of what we would say investors should be rooting for is kind of this idea of a split Congress. You think about how things are right now. There's 100 seats in the Senate, right? 33 or 51 Democrat, 49 Republican. Then you go to the House. Republicans have the smallest House majority in 140 years. All right, so that's gridlock. That's kind of why we think things that have happened in the past, Inflation Reduction Act, It wasn't about inflation reduction. It was about batteries and EVs. Okay, that's okay. Technology stuff. That's good. The Oh, what else do we have here? The CHIPS Act, right? Bringing things home. We don't like when China goes on lockdown, shutdown, and we want our chips for our phones and our cars and our remote controls and our TVs and all that stuff. So we're bringing that home. CHIPS Act, something both sides of the aisle agreed upon. And when you have gridlock, that can be good. The thing the government or the thing stock market doesn't like is red waves, blue waves, too much power one way or the other. Because then you can spend too much and get too frivolous, and markets don't always like that. So again, that division is kind of not division, but I guess division, split Congress is what we're looking for. But with the Senate, you got 33 seats up for reelection. 23 of them are Democrats defending those seats. So right away, it's a tougher map. That's what they call a tougher map for Democrats on the Senate. A lot of those states were states that Trump did really well in 2016, by the way, that potentially could flip back. So it's assumed that the Republicans probably take the Senate by a little bit. Then look at the House, exact opposite. The Democrats have a much easier path to gaining some seats as it pertains to the House. All in all, we think things are going to flip flop, and you'll still have a divided Congress. Now, Sam Stovall, big fan of Sam, he says the old saying goes, if the opposite of pro is con, then the opposite of progress must be Congress. There you go. But it's not about red. It's not about blue. It's about green. So I mentioned stocks do better under under Republicans when they control both chambers of Congress. Do a little bit worse when Democrats. You can see that blue and red. It's about green. When you have that split Congress, that's the returns. But here's what you really need to know. Since 1953, if you took $1,000 and only invested in Republican presidents on the stock market, you'd have about $29,000 right now. Same $1,000 only to Democrats. Have about double that almost, about 56, 57, 58,000. That's the power of compounding over time. It wasn't a huge gain, a huge difference per year, but over time and more Democratic presidents, you have a larger gain. Here's what you need to know. Take that same $1,000 and invested the whole time. Did not pay attention to who's in the White House. Just stayed invested. $1.8 million right now. All right. That's kind of the thing that we really tend to stress when I'm talking to financial advisors and their clients about the election and trying to invest in so and so. And I mean, believe me, I do this every day. I hear this every day. Oh my goodness, if she wins, I'm out. If he wins, I'm out. What I'm getting at. And we hear that all the time. But let's just remember that how the economy is doing, how inflation's doing, potentially what the corporate tax rate is up to. Some of those things really, really do matter more than who's in the White House. Of course, who's in the White House matters. I'm not minimizing it. I'm just saying there are some factors that tend to matter more. So let's talk about Congress. There's all the different splits, different scenarios, if you will, what potentially could happen here. So we'll see how it all shakes out. This is one of those cool charts to at least kind of be aware of. Now, honestly, if you talk to a statistics teacher, they say this is a really small sample size. You could throw it all out the window. I don't want to quite go to that extreme, but I still am in the camp that last 13 years of split Congress stocks were higher. This year's going to be 14. That's probably where we're going to be when we wake up November 6th, assuming we hit the results right away. That's where we could be, and that could be something most investors should be looking forward to. We're doing time wise. Oh my goodness, I go long. I always do. I'm going to wrap this up soon. The more things change, the more they are the same. Alphonse Carr, I like that one. So what's not going to change? Defense spending historically was very low relative to GDP this time a year ago, like the lowest since the early 80s. Look around the world. Look around the globe. Defense spending, whoever wins this election, is probably not going to slow down. It's going to continue to improve or increase is probably the better word to use. And what does that mean? Well, listen, defense is a big part of industrials. We don't see a recession. We think industrials are a group that whoever wins is probably still going to do pretty well into next year. And again, this defense spending is honestly potentially a tailwind for the economy. Saw in the 80s, a lot of defense spending. I mean, the government can spend money a lot of different ways, and I get it, defense spending, buying missiles, doing things, but no one's crazy about it. But the reality is these are some things that can create potential GDP growth and this overall spending, overall growth down the line. We're the largest oil producer, about 13 million barrels a day. That isn't going to change, right? I mean, we're seeing that under, obviously under President Biden. We saw that under President Trump. We don't think it's going to change if Trump or Harris win here, that we are the world's largest producer. Listen, and you hate to say, what are the most dangerous words? This time is different. Sir John Templeton, four most dangerous words. This time's different. It is different because the terrible things that happened on October 7th last year, oil spiked initially. But what's oil done? I mean, oil spiked here and there, and the war is still going on. The Middle East is still in turmoil, but it's not like crude oil is just soaring way past 104. Crude oil was like $145 back in 2008. All right. There's some deflation there, I guess you could say. And maybe there's different reasons why crude oil, but one of them is, again, the United States is pumping more oil than ever. I think I've got the number here. Yeah, production's doubled since 2011. All right, what anything else here? Production pulled back in 2015, 16 amid a weak economy. So yeah, production pulls back a weak economy. We're not sure there's such a weak economy coming, but all in all, we think production is going to remain strong. And with some of the issues out of the Middle East, well, the U.S. can pump a lot of oil now, right? This time is different. 73, 74 oil embargo, we couldn't do that, right? We did not have the luxury to do that back then. So this is something that's probably not going to change. I could spend a lot of time on this. I'm not going to. The US dollar is still the world's reserve currency. As long as anyone listening to this, we have the world's reserve currency. March of 20, what happened? Stocks were killed, bonds were killed. Look it up. Gold did not do well, March 20. You know what went up? The US dollar, the cleanest shirt in the dirty laundry. Um, I'm not saying it's great, right? We've got problems, we got issues, but during times of stress and fear, when the you know what hits the fan, people flock to the dollar. The first 10 months of 22, when stocks were doing terribly and bonds were doing the worst they've ever done, the dollar had like its strongest first 10 months to a year ever. So the first time we have a major crisis and the dollar is not a safe asset that people go to catch a bid, then I'll worry. But for now, we don't think it matters who wins this election. We have the world's reserve currency. And when you have the world's reserve currency, can you play by a different set of rules? Listen, I don't like a bunch of debt either. I'm not crazy about it. You're not crazy about it. Every time I speak, people say all about all the debt the country has. But when you have that world's reserve currency, maybe you can, to a degree, play by a different set of rules. And that's just the truth. In 1972, when gold was severed from, dollar was severed from gold, John Connally, a room full of bankers for Treasury Secretary for Nixon, said, you know what? It's our currency, but it's your problem. That, everyone, has been the attitude of debt ever since. I'm not saying it's right. I'm not saying I like it. I'm just saying when you have the world's reserve currency, and every time there's a crisis, we are reminded we do have it. That means you maybe can, to a degree, play by a different set of rules. George Carlin, bipartisan usually means larger than usual deception is being carried out. They would try to cancel George today, but I think we could we really could use him right now. This is just some different stats and figures and stuff we look at. I mean, the US dollar is still being used. You hear things like, oh, people in the Middle East aren't going to take the dollar, aren't going to take the dollar to do oil. None of it's true. All right. That's just media stuff. It's not true. They are taking the US dollar. Look around. I mean, I got the numbers there. Asian Pacific, what is this? 74% of all the transactions use the dollar. The rest of the world, a lot of dollar. Now, maybe not as much in Europe, but you know what? They've got the euro. They'll take your dollar in Europe. You ever been to Europe lately? Oh, they're going to take your dollar. Doesn't mean all those transactions are that way because they're using their own currency. But around the globe, people still take the dollar. The media hype up about Middle East and different countries not taking the dollar, this and that. Maybe Iran might be doing their own thing. But listen, the reality, Iran will take dollars if you give it to them. But the reality is, hey, the dollar's not going anywhere, and we're not seeing any reason to change that. This is just some more context on that. I'm not going to spend a ton of time on this. You can kind of glance at some of these things, but again, foreigners are quite happy to keep. They take our dollar when they buy. I mean, where is it? Foreigners sell a lot of goods to Americans. They get a dollar in exchange. The foreigners don't always buy an equivalent of U.S. goods with U.S. dollar. Instead, they choose to keep that U.S. dollar or U.S. financial assets like treasuries, which, hey, the U.S. is quite happy to supply that. So that isn't changing no matter who wins the election. I'm almost done. Hopefully, kind of hit my mark here time wise. Groucho Mark, politics is the art of looking for trouble, finding it everywhere, diagnosing it incorrectly, and applying the wrong remedies. Doesn't that sum things? I think I might be my last one. So with all that, again, thank you for having me. Thank you to everyone for listening. This was a lot of fun. I know I talk fast. I get into it. The TrendSpider team invited me to do this, and I've really enjoyed getting to speak about these things. I'm out there. I'm sure there's links and things. I'm on Twitter at Ryan Detrick. CarsonGroup.com/research is our blog, and then Facts versus Feelings is my podcast where Sonu Varghese and myself talk about all this stuff that we just shared, all these charts and things I just shared every single week. So listen, it's an honor. I hopefully get to do this again. There's a lot of amazing speakers. I can't wait to listen to a lot of the other speakers. Hopefully you get some time and check those out when you have time, because this election is very important. The reality is, wherever you side, just get out there and vote. Right, get out there. You have a voice. We all have a voice. It's very important to get out there and vote. And then, as a market strategist, we would say, let's hope for a split Congress. Because that's maybe the best scenario for those investors out there. So without, again, everyone, I'm Ryan. I'm honored to have been here. Thank you so much for listening. And I don't know who is after me, but I'm sure it's a great speaker. So enjoy, keep listening, and we'll see everybody next time. And Yeah, just reach out if I can help. But thank you again to TrendSpider. See everybody next time. Thank you.